Welcome to the Full Tracy Money Audio Commentary. This is Owen Tracy recording. It's 3:41 p.m. That is Central Time, and today is January 29th. Today is also Chinese New Year, so Gong Qi Fa Sai to anyone who's celebrating. What is quite funny in our house is my wife, Mrs. Tracy, passed on the little phrase that's a joke in Beijing, which is "Gong Qi Fa Sai Hong Bao Na Lai," which is that the child goes to the older person and says, "Happy New Year! Now where's my Hong Bao or my red envelope full of cash?" And in tribute to that, I'm going to make today's audio available for free to those pre-subscribers. When we think about what's going on today, there's a lot to talk about. And then the 2-year yield is up a little in here today. But when we look at it on a weekly chart, then it doesn't really figure much. It's off the low a little, but not a lot. And that's in response to Jay Powell's statement in the aftermath of the Fed's rate decision. They did not raise rates, and that was widely expected. They did tailor some of the language in the statement, which was immediately viewed as hawkish by the market. And then during the press conference, Jerome Powell was very clear to say, no, we were just clearing up some of the language, and that you don't have to worry about anything. We're not being particularly hawkish, but they're not cutting rates. And they're obviously aware of what tariffs are, and they're very keen not to make any public statements about it. But certainly, I think it's important to emphasize that the threat of potential inflation hasn't immediately disappeared. And the Fed has continued to say that they are looking at core PCE. So when we look at core PCE, and we know that their target is 2%, and the Federal Reserve has been absolutely adamant, and he said it again today, that they are not changing their target for inflation, and they're certainly not going to change it until they've reached it. Well, core PCE inflation looks like it bottomed in June, and it's now at 2.8%, and it's not really moving. Now, the next reading that we're going to have will be on the 31st of January, so only a couple of days from now. And the survey is for it to be unchanged. But if that starts to rise, well, I think we would have to start to begin to be a bit more serious in thinking that the next significant move by the Federal Reserve will be to hike rates, not to cut rates. Now, when we look at what else is going on in the world, well, what's happening in Canada is also particularly noteworthy, because here we have the 2-year yield that is trending downwards and dropped to a new reaction low in here today. Two important pieces of news are that the Bank of Canada has cut interest rates, and they're down to 3% now, so that's quite a wide interest rate differential between Canada and the USA. Additionally, they're about to begin quantitative easing again. So they've abandoned quantitative tightening, and it's looking increasingly likely that they will start buying assets once more. So that is seriously reflective of weakening growth fundamentals in Canada. There's a lot of political distress, and there's, I think, a revolt against I hesitate to use the word woke, but certainly the more progressive policies that the current administration have implemented, but most particularly because they really went on the attack against the people that supply them with energy and food, without really contemplating that those people represent a sizable proportion of the overall population. And it is a further reflection of a global trend away from the fringe left, and perhaps back more towards the middle. Of course, now what's considered the middle is quite a long way from where the middle used to be before. When we think about what that means for the USA, I think this is a great example of how much the middle has moved. We can look at the number of deportations in the USA, and they were up at significant peaks right at the end of the Bush administration, and all the way through the Obama administration, particularly the first 4 years. Now, in the Trump administration, they didn't really move all that much. In fact, they were starting to drop in 2020, and deportations just almost disappeared during the initial phase of the Biden administration. When it became an election issue, well, then deportations got straight back up again. But they're nowhere near as high as they were during the Obama administration. What it helps to emphasize is that the perception of the necessity for deportations tends to move around with the political environment as well as the economic environment. And we might conclude that during the years from 2004 through to 2006, deportations weren't really a factor because the economy was expanding rather well. It was during the early years of the Obama administration following the global financial crisis when economic activity was significantly reduced, and there was a lot of fear around, particularly as a result of the foreclosure crisis, that deportations went up. So immigration, deportation are like pressure release valves for the US economy. Now, when we think about what else is going on here, well, the Canadian dollar is taking the brunt of the sell-off in the interest rate environment. So with yields compressing, that's putting downward pressure on the Canadian dollar. Now, I think it's particularly important to emphasize that this is a significant period where we might see either support starting to come through because we're in the region of the lows from 2016 and 2020. But so far, at least, it looks like an unwinding of the short-term oversold condition and that there is potential for additional downward pressure. And you have to go all the way back to the beginning of the century to see a time when the Canadian dollar was trading significantly below about 69 cents. And it got all the way down to a new low in 2002. And after that, it almost doubled over the next 5 years. So it's not like the Canadian dollar is perennially going to be weak, but the growth divergence as well as the interest rate divergence between the USA and Canada is certainly weighing. Then let's think about what that means for the price of gold in Canadian dollars. With such a weak currency and gold being quite steady, then it's trending higher in really quite a consistent manner. And that is likely to be beneficial for the gold mining sector. Now, gold mines have not been keeping pace with the advance in the gold price over the last several months, but we've had 4 consecutive weeks on the upside, and if we get some additional upside tomorrow, it'll be 5, or through the balance of the week, I should say, it'll be 5. And this also, I think, behooves us to look at a longer term chart, because the more back history we look at, the more this looks like a long first step above the base. And this range that's been forming since 2020 has a rounding characteristic. Now, you might have to take out fuzzy glasses to see it, but it does look like there was an important low in 2022. There's been a very large amount of volatile activity where it is exceptionally choppy. But let's just pay attention to the red line on the chart, where it attempts to strip out a lot of that volatility by looking at the moving average, which was trending downwards into the low in 2023 and subsequently has been rising. Even during the bull phase in 2009 through 11, it was exceptionally choppy. And of course, what this reflects is the uncertainty of the mining prospect. You just don't know what you're going to get as soon as you start drilling. Now, when we think about what else is notable in the markets today, well, we've had earnings coming through after hours. So let's start off with Microsoft. Microsoft earnings were stronger than expected, but earnings from the cloud were not as impressive as expected. So the share is trading down a bit in here today, but not in an especially material fashion. So we're probably going to see some additional consolidation here. Then Tesla also saw that its earnings were not as impressive as expected, and it's been bobbing around. So the share initially went down and now has rebounded in the after hours, so it's back above 400. So what we're seeing from Tesla is that their earnings haven't been as good as expected, but they do anticipate releasing new vehicles. They do anticipate having robo-taxis, and they expect that those new iterations of the business model will contribute to better earnings in future. So at least in the after hours, the market is giving them the benefit of the doubt. Now, we're going to have Meta's earnings in the next 20 minutes or so. And the share has been trending higher in a consistent manner, and much more consistent, in fact, than either Microsoft or Tesla. One of the reasons why Meta open sourced its AI data was because Meta doesn't anticipate that it's going to be a big money spinner for the company. And they wanted to, almost altruistically, but they wanted to further the aim of developing artificial intelligence by bringing in as many outside researchers as possible. So they outsourced their data. And that has been one of the primary seeds for the AI trend, because Meta took something that took an enormous amount of money to create and basically gave it away. One of the big, I think, or the most significant events as part of the DeepSeek innovations that have been released this week is that their data has also been open sourced. Whereas ChatGPT has closed off their data, and they did that several years ago, and primarily because they don't have another income source, and they want to be able to charge for their chatbots. They want to be able to charge for the tools that are created on the back of it, and that's also Microsoft's business model. But if Meta is going to acquire the know-how that DeepSeek has made available and reduce the inference cost of the AI it's developing, well, then that is certainly going to cut into the competitive advantage that OpenAI has. And that, of course, will weigh on Microsoft, but it's potentially likely to benefit Meta because Meta makes money from advertising. And in fact, they probably would benefit more from the USA banning TikTok or TikTok being cut off from its Chinese parent than any kind of innovation that occurs in AI. So certainly the earnings will be important to pay attention to in the next half hour or so. When we then zoom out and look at the overall NASDAQ 100, well, one thing that's been very clear this week is that we might have had volatility in the largest companies, but the performance more or less has been quite steady. And the NASDAQ 100 is still holding within its range. Economic growth is still coming in around 3%, and we're still in a reasonably benign environment. Of course, there is the wrinkle in all of this that if the Federal Reserve is likely to raise interest rates at some point, then that is going to eat into the valuations that are acceptable in the wider market and puts additional pressure on companies that they have to persist in growing their earnings. Now, when we think about the kinds of factors that would contribute to an economic boom, there's an enormous amount of media attention on the tariffs, and I think there's a good reason for that, because it certainly makes for headlines, and the media are very much accustomed to taking politicians at their word and just writing news headlines as they have basically been instructed by their political overlords. Well, what President Trump thinks is of tariffs is probably that they're policy tools. And we saw an example of that with how Colombia was treated when they refused to take back their own citizens. And I think that that is certainly going to be part of the calculus in future. But what we don't seem to see is much more coverage of deregulation. So oil prices continue to pull back from the $80 area and coming back down towards the lower side of this range that's been forming for the last 2.5 years. So this is a clear failure in the $80 area and the region of both the 1,000-day and the 200-day moving averages. And we're still in a ranging environment which tells us that supply and demand are still in relative equilibrium. But there's been a downward bias to trading for more than 2 years with a sequence of lower rally highs. So we can't rule out the possibility that the risks are now on the downside, and particularly when the clear effort of the new administration is to ensure that there is plenty of new supply hitting the market. Now we've had quite a lot of volatility in natural gas prices, and that I'm just looking at the front contract right now. So the price has come down from 380 to 307 over the last 2 weeks, and now we're starting to see the first evidence of support starting to come through here. And I think this is also rather important because today we saw quite a lot of strength beginning to come through in a large number of soft commodities. So corn has rallied now from 400 to 500 in the space of only 3.5 months. So this is certainly something that we should pay attention to because it has broken the medium-term downtrend. And it might be testing the region of the 1,000-day moving average, but the more important point is that it has broken the downtrend that's been in evidence since the peak in 2022. And then when we look at the rest of these soft commodities, wheat is also steadying here at the lower side of its base formation. And this does look like a base formation, and it does look like we're going to see additional upside from here. Then when we think about soybeans, this is also a developing new trend where it's looking increasingly likely that we're about to see a breakout from this base formation that's been forming at the upper side of the preceding long-term base, and that it does look like it's going to break this downward bias that we've seen for the last 3 years. Then let's think about Arabica coffee, because the front month contract is now up to over 350. In fact, it's 366. We're talking about new all-time highs. And this is not just an all-time high when we think about the last few years. You have to go all the way back to 1975 to see a time when the price has been able to sustain a move above $3. So this is a material change, and this monthly chart needs to be updated. So this is, I think, really rather a significant move, and it suggests that we're in new high ground. And unfortunately, the problems are that it's not going to be easy to increase supply. On the one hand, there are unfavorable climate conditions in Brazil right now. Then you have competition from other cash crops. Cash crops like durian in Vietnam are pressuring the price of Robusta coffee higher. Then I saw a headline today is that there is more coca under cultivation in Brazil than ever before. Well, coca grows in much the same kinds of latitudes and elevations as coffee does. So that's certainly a more productive cash crop for a lot of farmers in those areas than coffee is. So this is putting upward pressure on the price. And this is obviously going to have a material impact on the perception of inflation when people start having to pay a lot more for their coffee. Then let's think about cocoa. Again, this is a highly concentrated production region, and the price is still holding in the region of the peak put in at the beginning of 2024. I think this is also a good example of what happens after a big breakout from an exceptionally lengthy range. That once the price breaks out, then we are in new high territory, and it's quite normal to anticipate that prices just don't go back down. And this is a clear result of the GATT negotiations that concluded in the late 1990s. And the removal of subsidies for the production of commodities, really the net effect of that was to concentrate production in the cheapest locations around the world. Now that those locations are experiencing stress, we're seeing that a lot of different commodities are pushing on the upside. So then when we think about the agricultural commodity index, this our ETF continues to advance. And it's important to emphasize that this is a futures fund. So when futures funds advance, you need to have both a backwardation and a strong trend, because without those, they generally trend downwards. So a good example of that is the US oil fund. And that has been a disastrous investment from the perspective of investors. And for the longest time, it just underperformed. And they only were able to curtail that underperformance by changing the signaling around when they're going to roll their contracts. But it's been a singularly bad investment for anyone who wanted to buy oil. So when we see the agricultural fund that's going higher, well, it tells us that there are strong trends in evidence. And that is certainly something that is going to pressure some of the perceptions around inflation. So we're in an interesting environment here where the best performing stocks are going through an earnings season where so far at least the earnings have not been stellar. And then we can think about the promise of deregulation, which is likely to create credit, particularly from the banking sector. And this, I think, is something that's rather important, that we have banking sectors everywhere that are trending higher. So the S&P 500 banks is at a new high, although it's pausing in here today, and probably more in response to the Fed action that they are probably likely to hold rates for a while, and that the risk is that they will continue to raise rates. But Canadian banks, European banks, UK banks, they're all trending higher. This suggests that if we're going to answer the question of where the new liquidity is going to come from, well, the chances are that it's going to be bank credit that is going to increase, because central banks are reluctant to engage in massive quantitative easing programs, and governments are tapped out on the fiscal front. So there's likely to be a credit boom through the banking sector to re-stimulate global economies, and that is certainly helping to support the stock prices. We have to at least give some credence to the view that inflation is going to remain sticky, and not least because agricultural commodity prices are rising amid an environment where there is the potential for credit to increase, and that is something that could also be inflationary. So with that, I'll leave you for today, and I'll wish all the best to all of you.